Hey everyone, welcome back to Corporate Decoder, the place where we dig into company filings. Today we're decoding Alvotech's annual report. This report is more than just numbers, it's a roller coaster of debt, biosimilars, and a few regulatory headaches. We'll break down what all this means for Alvotech and its investors, and hopefully keep it interesting. This report covers Alvotech's performance up to the end of last year. First things first, this isn't just a routine check-the-box exercise. Alvotech says its internal controls over financial reporting weren't up to par, which means an increased risk of errors and financial misstatements in the past. Let's jump into the financials. Starting with a concerning figure, Alvotech's accumulated deficit is almost $2.5 billion. That means they've lost that much money since they started and a long road to profitability. Even though Alvotech has been losing money for years, last year's loss was actually lower than the two previous years. So they are losing less money, a step in the right direction. Now that might sound scary, but Alvotech is not worried and believes they have enough money to continue operating as a going concern. However, they do flag that they might need to get more cash to stay afloat. They list a whole bunch of things that might require funding, such as preparing to launch new drugs, continuing clinical trials, dealing with any legal troubles, and creating a marketing infrastructure. So they are not sure about it, but it's a risk. But here's a bigger number. Alvotech is carrying a massive debt burden, over $1 billion. This can have nasty consequences, as if they fail to generate enough cash, creditors could seize their assets, including their precious intellectual property, which is pledged as collateral. Adding to the cost, Alvotech is now required to comply with all the EU's green guidelines. To sell the drugs they create, Alvotech relies on partners, and those partners are very important. If those partners stumble, Alvotech's revenue takes a hit and it will have major effects on their business. Getting regulatory approval for drugs is a long and uncertain process, and the report stresses that their applications could be rejected for many reasons, such as manufacturing issues or not enough data to prove the drug works. The other problem they cite is Brexit, which makes regulatory approval in the UK very tricky. The report also warns that all these clinical trials are expensive and can fail at any time and can take many years, which can require even more investments. The report points out even global events could delay their study and is careful to mention both COVID and the conflict in Ukraine. And there are ongoing regulatory obligations for the approved drugs. So even if everything goes perfectly, authorities might try to withdraw approval or impose extra requirements later on. The report also mentions their people and says that their operations could face disruption if immigration laws make it difficult for talented employees to stay. In addition, their biosimilar candidates will face significant competition. So even if they do manage to get a drug approved, they might have trouble gaining market share. Here's an important one. Alvotech admits to having a material weakness in their internal control over financial reporting. If they can't fix it, it could mean inaccurate financials and a loss of investor confidence. Finally, there are a few regulations that might affect them. There is the sustainability reporting in EU. Their business is also heavily dependent on the success of a small number of products, which can be problematic. There is also the omnibus packages in the EU, which is still under review and will have an effect in 2026. Now let's talk about cybersecurity. Alvotech seems aware and on top of this with procedures and partners. Here's where we see something a bit new, or that wasn't emphasized before. A lot of Alvotech's problems are because their operational and financial results are subject to concentration risk. This may disproportionately affect our global results. As of December 31, they have only generated product revenue through sales of AVT02 in the United States, Canada, Australia, and select European markets. Through certain commercialization partners and of AVT04 in Canada, Japan, and select European markets, through certain commercialization partners and of AVT04 in Canada, Japan, and select European markets, through certain commercialization partner 1, they have only generated product revenue through sales of AVT02 in the United States, Canada, Australia, and select European markets through certain commercialization partners, and of AVT04 in Canada, Japan, and select European markets through certain commercialization partners, and of AVT04 in Canada, Japan, and they are now estimating a number of other expenses in order to be fully compliant with the SEC. Okay, let's very quickly talk about the number of outstanding shares. its 301 million ordinary shares and 9.9 million warrants to purchase ordinary shares. But lastly, I love to check the table of contents to see if there is anything important in here, and there isn't, other than what we have already talked about. So what's the verdict here? Alvotech is a company trying to make biosimilars cheaper, but they face an uphill battle. While their losses are decreasing, their high debt and internal control issues are serious red flags. Their dependence on partners and a few key products makes them vulnerable. On the other hand, they are investing in their own manufacturing plant, which could lead to vertical integration and might get more flexibility in the long run. If Alvotech can improve its controls and manage the debt, their future looks promising. If not, this could be a bumpy ride for investors. Thanks for watching, and don't forget to like, comment, and subscribe for more corporate deep dives.